Welcome to your ultimate auditory companion for mastering the fundamentals of accounting. Whether you are prepping for an exam, building your professional foundation, or just curious about how the financial world balances, this guide is designed to fit your life. You can listen to these 65 facts on the accounting equation anywhere and anytime. Let them wash over you while you sleep to reinforce your memory, keep your mind sharp during a long drive, or absorb them while relaxing on the beach. Learning has never been this flexible. 1. The entire world of accounting rests on one simple equation: assets equals liabilities plus equity. 2. It is also called the balance sheet equation. 3. Think of it as a balance scale. Everything on the left must equal everything on the right. 4. An asset is something you own that has value. 5. A liability is a debt, something you owe to someone else. 6. Equity is what's left for the owners after all debts are paid. 7. The equation must always stay in balance after every transaction. 8. This equation is the mathematical foundation of double-entry bookkeeping. 9. Every single transaction affects at least 2 different accounts. 10. If you add value to one side, you must add equal value to the other side, or subtract from the same side. 11. This is called the double entry system. Every story has 2 sides. 12. In accounting, debit just means the left side of the scale. 13. Credit just means the right side of the scale. 14. Debits and credits are not good or bad. They're just directions, like north and south. 15. Total debits always equal total credits in the entire ledger. 16. Assets are your resources, like cash, equipment, or products you sell. 17. Assets can be tangible, physical, like equipment, land, or buildings. 18. Assets can also be intangible, non-physical, like patents and goodwill. 19. Current assets turn into cash within one operating cycle, usually 1 year. 20. Non-current assets are things you keep long-term, like machinery or buildings. 21. Cash is the most liquid asset. It's ready to spend right now. 22. Accounts. Receivable is money customers owe you for work you already finished. 23. Inventory is the stuff you plan to sell to make a profit. 24. Inventory includes raw materials, work in process, and finished products. 25. Fixed assets, PP&E, are long-term tangible assets used in core operations. 26. Depreciation tracks the wear and tear of an asset over time. 27. Accumulated depreciation is a contra asset that systematically tracks asset wear. 28. Net book value equals what you paid minus accumulated depreciation. 29. Assets naturally increase with a debit and decrease with a credit. 30. Liabilities are your promises to pay, like bank loans or unpaid supplier bills. 31. Liabilities are present legal obligations from past transactions. 32. Common liabilities include accounts payable, loans, mortgages, and bonds. 33. Current liabilities are due within 12 months. 34. Long-term liabilities are due after 12 months. 35. Accounts payable is money you owe to suppliers who gave you materials. 36. Notes payable are formal written loans with specific interest terms. 37. Accrued expenses are costs recognized but not yet billed or paid. 38. If you get paid before you do the work, that's unearned revenue, a liability. 39. You owe that service to the customer, so it's a debt until the work is done. 40. Long-term liabilities structurally fund permanent assets through multi-year notes and bonds. 41. Liabilities naturally increase with a credit and decrease with a debit. 42. Equity is the owner's stake in the business. 43. Equity represents the complete value claim held by owners against asset bases. 44. Equity varies by legal form: owner's capital, partner balances, or shareholder equity. 45. Equity grows when owners invest their own money into the company. 46. Equity also grows when the business makes a profit. 47. Revenue is the money you earn from selling goods or services. 48. Expenses are the costs you pay to run the business: rent, salaries, utilities, etc. 49. When revenue greater than expenses, you have net income, which adds to equity. 50. When expenses greater than revenue, you have a net loss, which shrinks equity. 51. Retained earnings equals beginning balance plus net income minus dividends. 52. Retained earnings is the pile of profit you keep in the business instead of paying out. 53. Dividends are payments to owners from profits. 54. Paying dividends reduces cash and reduces equity. 55. Common stock tracks the baseline par value of ownership stakes. 56. Preferred stockholders receive priority access during dividend distributions. 57. Treasury stock is a contra-equity account for shares bought back by the company. 58. Paid-in capital is money shareholders paid above the stock's par value. 59. Equity structural line items increase via credits and decrease via debits. 60. Expenses increase with the debit, left. 61. When you buy an asset, you debit the asset account. 62. Liabilities increase with a credit, right? 63. Equity increases with a credit, right? 64. Revenue increases with a credit, right? 65. Assets and expenses live on the left. Liabilities, equity, and revenue live on the right. You've just journeyed through the core pillars of accounting. Remember, these 65 facts aren't just definitions. They are the language of business. Whether you are aiming to ace your next exam or simply looking to understand how the world of money works, consistency is your greatest asset. Keep these principles in mind, and you'll find that everything eventually balances out. Well done on taking this step toward mastery.